I think that we're now recording. And what we're going to talk about on this episode of Real Estate Chat is where we've been and why it's different. And now what? Well, first of all, John, my confidant and encourager, has been promoted to the head office high-tech guru. So he is going to give me some tips from now and then, but I'm going to more or less do this on my own. January has just been released by the Toronto Real Estate Board, and we are looking at the results that came out of Market Watch. Why we didn't do a end of December 2024 is because I disputed the 15% variance between what I calculated monthly on Realm and what they published on their market report. But what the heck? December is the least important month of the whole year. And so we don't worry about it. Okay. So let's start off with everything that we're going to talk about. Anybody who's familiar with Real Estate Chat knows that any review of 2024 and any projections into 2025, it's got to be based around what type of customer we're dealing with. So what type of customer are you? Here's the ones that we look at. Are you a first-time buyer with nothing to sell? Are you a last-time seller with nothing to buy? Did you buy before 2003? So you have lots of equity. It's a simple story to sell that property. Or did you buy after 2014? Is it a long and complicated story that maybe it's a little difficult for you to get every nickel back out? Number three, are you a buy and sell customer where you're trading up or you're trading down? Both of them are a financial upgrade. Are you an investor who will be underwater, meaning you won't get all your money back if you sold today? Or you're an investor who'd be in the money, probably related to when you bought it as well. Okay, so each of those people are individuals or families, and they have to plug into the scenario that they imagine will be coming to fruition in the coming year. So do they imagine the seller's best case scenario where prices stabilize at 78, 72? Start again, where prices stabilize at 82.5% of peak. Right now we're at 78%. And rates, 5-year fixed, are 3.25 to 3.75, still a little bit higher than that. Do we think it's going to be a buyer's best case scenario where prices stabilize at 62.5% at peak, off almost 40%, far, far worse than we've ever seen, and 5-year fixed rates, because of the terrible situation that will force it to happen, are at 2.75 to 3.75? Or are we going to be in the mushy middle? Might be, where prices stabilize at 72.5 of peak, and rates are somewhere between 3.5 on a 5-year fixed. So what type of buyer you are and what type of future you see happening is going to be dictating your understanding, your appreciation, and what you glean from what we're going to say now. Okay. So the Toronto Real Estate Board came out with their market watch the other day, Feb 5. And we heard a lot of things about interest rates. We heard about prices being up, and we heard about prices being down, and we heard about inventory being up, and all of them encouraging us to do exactly what the real estate brokerage members of the Toronto Real Estate Board would want you to do. Get off your duff and do something. What we've been suffering from is a low point of sales and a lot of listings and lots of things sitting, and nobody wants to seem to do anything about buying them. So when we see any one of the categories which we'll examine, which is price, sales, listings, both new listings and inventory listings, and the pace of the market. So is it hot? Is it cool? Is it flat? Is it warming? Is it cooling? We'll look at each one of those. And those of you who listen to the channel before, you know that I'm in favor of comparing everything today to the 10-year average. And from the 10-year average, we can figure out what's normal. Things have been hot for such a long time that I've been starting to use the 20-year average because it's a ratio between the sales and the listing, whatever, not the absolute number. In some cases, it's an absolute number. So that a trend can be established. And are we above it? Are we below it? Are we seeking a higher market? Are we seeking a lower market? Or does it indicate that we might be? Okay. So what we're going to tell you is what you can expect based on your situation, not what some pundit at the newspaper might say, or what some bank financed or bank employed pundit who looks at the real estate business from the Canadian Real Estate Association's statistics every month. But what you might just assume you're getting, what you're hearing, what you're learning from the Toronto Real Estate Board statistics that have just come out. Okay. The results in last year, before our Prime Minister asked for a prorogation of the Canadian Parliament, and before Mr. Trump started his 100 days of action, and notwithstanding the fact that we had a 0.25 drop in the Canadian interest rates, the Canadian people have found, as many places as they look, a reason to do nothing. There's lots of reasons to do nothing. And so that's what they're doing. The first half of January was dead slow. Now that's always the way it is. It depends on the weather. It depends on when the kids' school break occurs, all these things. But what we have now is a look at what just happened on the Market Watch, and whether they said the sales are up compared to last month and the listings are up, of course, compared to last month. The sales are up compared to last year, and prices are up compared to last year. So it feels, if you listen to the board's report, that a hot market must be coming. So what's really happening in our look at prices over time, the last 24 years showed that 9 years were sort of down years and 15 years were up years. And the average over the whole, all of the 9 years was minus 268. So I had done an initial guess at where the market was going to be, whether it was going to come out at 138, 1038, and it came out at 1040. So the current average price down 2.45% is 22% off the peak, 1040994. If we look at this on the regular calendar January to December chart, we can see it. It's very vague because it doesn't show well in January. We're up 139 from a year ago. Yep. And we're way down from the absolute peak that we saw in 22. From the month of December, we're down, but as we said before, that's very normal. And we're off from the maximum 16%. So this one shows you that there's absolutely nothing wrong with this market, except we're comparing it, when we compare it to this balloon, this boom that we saw in 2022. So this is same information, except on what I call the school year chart, sort of like a fiscal year for real estate that starts with the school year in September and ends in August, starts again. And we can see that sales this is the price of average price, which is all the sales divided by all the prices, and it's following the trend completely. So this says that there's nothing extraordinary, nothing to get all excited about. We're on trend, and we're on season, and we're on expectation. Okay. If we look for prices, and this is one thing we did about a year ago with the varying, modifying what was done by a fellow named Robert Ede, who's with the Bank of Montreal, Royal Bank of Canada, I'm sorry. And he put all of the peaks on a constant 100 and then plugged them all in together and said, where do they all go? And he came up with a conclusion that didn't quite work for Toronto because we're able to use monthly, he used quarterly, variety of different things. All we learned from this is at um, 3 or 4 peaks had returned to 90% of their own peak on or before 24 months. The exception is 1989 to 96, and that's the one that we're using as our pattern. And you can see the red line here going up and down. We're in the middle, in between this, lining up the tops and lining up the bottoms, which technical analysis, it's a way of doing things that you cannot apply to these numbers. But it shows you we're in the middle, and it goes up and down, depends on the season, and it depends on, well, it all boils down to supply and demand and consumer confidence and interest rates. And most of the consumer confidence comes from what they see in the newspaper, what they see on the TV, and what they hear is happening around them. If they can see that prices are going up, then they want to have a piece of it. If they see prices are not going anywhere, then the buying public who doesn't own a property, will do nothing. And the real estate market, residential, resale, starts at the bottom. The first-time buyer gets the cycle going, they move up and they move up, they move up. So that's why the first-time buyer is so very important. Okay, so right now at 78% of the peak, 10,040,944 versus 1.33 change a couple of years ago. And we seem to be on pattern, seasonal, and ready to go. The prognosis is that there's more of the same ahead. Okay, if we look at sales, this is again is another January to December chart, and there's our star over here. That's where we are. This is the 23rd best January, which is, if we look up here, 9% off last year. But much better than we've been doing many of the months of the years we've been following where it's 30% off. We're 14% off the average. Now, what we're going to need is for the sales, first of all, to get up to the average, be it in February or in March or whatever month it's going to be, that will show us something. When it gets up to the average, then it'll show us that we're breaking through and breaking out of the doldrums. People have decided that it's time for them, and again, first-time buyers, it's time for them to make a move. So if we switch over to the school year chart, we can see the big spread stars, and we're completely on season. We're completely on trend. We're a little bit better than we were in December, and far, far below, well, a little bit below, 14%, 17% below the average for January. Okay, so what about inventory? Are there lots of listings? We hear that they're way up. Okay, but that's what happens every year. The 5-year average, November to December, goes down 35%. So we went down quite a bit, and we've ticked up a bit. Now, we ticked up 11.5%, and a year ago we ticked down minus 2.7. So there's something happening this year that's different than last year. And if you are looking at the daily listings as they come through, you'll notice that there's a lot of properties that are coming through as new listings that you recognize, that you say, oh, I saw that one last year. I saw that one back in September. And properties where the seller is underwater or pressed to sell for some other reason are coming back again at lower price, no more holding offers. Let me get rid of it, is what they're saying. So the number of listings is going up. Inventory is one thing that we watch. Are any of these new? When we're categorizing as new, it means a property we have not seen ever before. We haven't seen for 10 years when it traded and this person's family bought it. But active listings are now trending back up again. So we've got a little over 17 with 3,800 and some change sales. We have 4.5 months of inventory. Is that above or below? Well, if we look at the 17-year average, I'm sorry, we're still 50% above it. The 10-year average, we're 90% above it, and the 5-year average, 121%. So there's a lot of extra listings. So how do we monitor? How do we monitor the pace of the market? We look at months of inventory. We take the inventory that there was, 17 and change, we divide it into sales, and we get a months of inventory. We said it was 4.46. Now, 4 is a magic number, which we saw happening in the worst of times, leading up to and including the global financial crisis, going back to '08 and '09. There's a lot of price adjustments that happened there. And another line here that was happening a few times, leading up to and in between the rallies that we had in the springs where things got low, low, low. 3 months of inventory we'd like to see. 4 months of inventory, we haven't been there for a little while. Let's hope we get there. And 2, that's such a crazy market, we probably don't desire that again either. Okay. Now, the other way to check the pace of the market is to look at the days of the market. This is now in 2 categories, broken apart because the property days on the market is all of the times that a certain property that does sell was listed, get added together. And so it adds up to 55 days. And we compare that with the listing days on the market, the number of days of a listing that sells. Never mind whether it was for sale 7 times before, 4 times before, or 1 time before. Only the last one is 37 days, which means it takes about a month. Now, over the course of my career, which goes back to 1974, having a property sell in a week is great. In 2 weeks is pretty darn good. In 3 weeks or a month is normal. Sometimes you have a 90-day listing, you have a 60-day listing, it expires on you. You've had a few showings all the way through, it just does not sell. So what we see here is that the definition is if it's the same owner, the same property, the same real estate brokerage under the for sale more than once, canceled, terminated, and relisted during the same period of time that the original listing was. The original listing is for 65 days, 75 days. If it's relisted 2 or 3 times, then you add those all together, it becomes a relist. And so they will add together to be the property days on the market. So the difference here, which is 20 days, is how you add them all together and see where the pace of the market is going. The previous 5-year average for properties of all types was 36, so we're quite a bit above that. The previous 5 years was 26 for what's now 37. So it's a little bit slower than you often see. Now, if you want to look at new listings, we can't do the chart that I normally do, which is subtracting the number that is quoted to be relisted, the number that same owner, same broker, same property in the original period have been repeated. And they have been publishing that for a while, but in November there was a glitch. In December they didn't publish it. In January they didn't publish it, and then they put November back. And so I'm just using an average a percentage of 20% share. So the difference between the blue line and the red line is if you take the blue line, it's the announced, published number of new listings, which seems that it's up. And the red one is minus the 20% relists. So the average number of listings over the last 10 years is 8,500, and 8,200 is the 5-year average. So at 12 something, we're 45% over that. So there's more listings than we need. Now, this sales to new listing ratio is something that percolates all the way through the system. The board, Toronto Real Estate Board, and every other board uses the statistics because Canadian Real Estate Association has used this statistic. And they've come up with either 40 or 45 or 60 or 65 as the difference between a seller's market, if it's hot, the balanced market in between, and under 42.5, the same as the buyer's market. So in this particular case, if you use the standard method, no relist subtraction, 31% of the listings that come through are being absorbed. So that says an extreme buyer's market, 42% being the cutoff. If you subtract 20%, which as I see as conservative, might probably be closer to 30%, then the net new listings ratio to the number of sales is more like 38%. So we're still in buyer's market territory. So what we say from looking at all these indicators and talking all this talk is that the market is good if you have a good listing. The market is Slow if you have a listing that people do not see as value. Anything brand new will come and people have a look at it, and what is it back onto, and what's the interior condition, what's the price, and are they asking that price in hopes of getting more with a hold date, or just saying they'd like to get 100% of that sale price. So there's always action on something new we've never seen before. It's an estate sale of someone who's moving to Calgary, they got to transfer, whatever the reason is. But if it's something where the tenant has just finally moved up and it's beat and it backs onto a plaza, and there's nobody cares about things that have nuisance factors associated with them. So I guess the final thing that we'll look at is there a difference between 416 and 905? Well, 905 used to have lower prices on average, which is all of the things that sell compared to uh, everywhere else. Now, recently, last couple of months, 905 has been a higher price. This particular time, it's nearly 9%. Now, why is that? It's because it's a first-time buyer's market. If you look at this daily, you'll see that of all the sales that are occurring, 70% of them are freehold. Now, that means that 30% are condo. In the normal days, it's 60-40, where there's 60% freehold and 40% condo. It's higher in the city of Toronto. The average price in the city of Toronto 416 is now below $1,985,000, which is largely because the freehold is not taken off yet. January, slow start, and in 416, but the condo has. And the 905 freehold has caught, and that's what people are buying. They're buying in the suburbs, avoiding that second land transfer tax, and buying a freehold property rather than a condominium of some kind. And they're paying, what's the price? 1,072. So it's not a huge difference, but it's still 8-9%. There's not millions of them. The 905 average, we're still 16.5% off the 10-year average. We're in Toronto, we're 20% off. So there's nothing wrong with it, except it's not spectacular. There's not enough sales, and there's far too many listings for price to go up. So bottom line, what does the future hold? Second verse, same as the first. Depends on what type of customer you are and what you have already decided the future will be. I'm not going to try and change your mind. You're going to have to decide whether it's up, down, or sideways, and if this is the time for you. So again, this is where we were at the very beginning. Your first time buyer, last time seller, have you bought that property a long time ago or recently? Are you a trade-up customer who's moving to buy another one, or buying first or selling first? Of course, the answer to that question all the time is you do the tough thing first. If there's lots of what you want to buy, then you let that go. You sell you do the thing that's tough. If selling is harder, then you do that first. And are you an investor who'd be underwater? Maybe you're not even thinking about selling. If you're an investor who would not, or who would be in the money, you might be thinking of it, but why sell something that's good? So best case, mushy metal, or worst case. If you're a buyer, do you think the market will be flat for a while? How long will it be flat? And then what? Bad? Will it be slow to return to good? Will we have a rough patch when all these uncertainties get straightened out, and then full steam ahead due to lower than expected interest rates? Because we do not know what the interest rates are going to be. We know they're going to be a half lower at the end of the year. Are they going to be a full percentage lower than they are right now? And believe you me, we do not want them to be a full point lower, because that means we've had terrible economic news in the meantime. Okay. If you're a seller, where are you going? If you sell that home you've been in for 35 years, where are you going to go? When do you need to be there? Why would you like to sell? Can you comfortably wait? And if you can't comfortably wait, what's holding you back now? What's keeping you uncomfortable? Again, Jonder is in the background. I'm in the front line, trying to help as many people as I can who'd like to buy or like to sell. And you're enduring my initial opportunity to learn how to do a broadcast on my own. And I thought I was going to show up on it, but it doesn't look like I have. So um, we'll call it there and see you next time. Okay, bye for now. Well, that says we're still recording.